All right. Well, welcome everyone. Thank you for joining us on this third installment of property insurance and liability insurance with our guest Sterling Fairholm. In the first installment, we did homeowners condo insurance and the market update of insurance in general. In the second installment, we did rental landlord policies for residential properties. And then in this one, we're going to be talking about vacant properties, construction loans for our fix and flip clients, what type of insurance they would have to work with. So before we start, Sterling, would you please introduce yourself again?
Sure. Yeah, my name is Sterling Fairholm. I'm a property and casualty broker and owner with Reliance Insurance Brokers, and I specialize in everything P&C related. So this type of segment is right up my alley.
P&C is property and casualty?
Property and casualty. So a P&C broker is basically somebody who doesn't do health, benefits, dental, vision, things of that. So we're all looking at property related, auto, personal lines, different business lines, general and professional liabilities.
Got it. Okay. And your coverage space is throughout California.
I'm actually everything west of Colorado. However, California is our main hub and it's our main office. So I'd say 95% of business does come out of California. Each market's a little bit different, but California is the most distressed, besides Florida. But that's everybody knows that.
The most distressed.
Yes.
Okay. Interesting. Okay. So on this topic of vacant, fix and flip, and construction property insurance, the first question that I have is going back to the basics. Does a typical homeowners insurance or a rental property insurance cover construction-related damage or risks?
Yeah, so the short answer to that is no. A homeowner's policy has typically a pretty clear provision that says that construction-related activities are not covered by the policy. Now, that's a general statement, and the difference would be a homeowner's policy would cover construction-related items if it was you were replacing your floors or you were painting or doing something minor. But anything that involves a vacancy, so if you move out of the home in order to redo it, or if you purchase a home and it's vacant and you're doing remodeling, that is completely against a homeowner's form, landlord form, or any of the other regular home packages. There is typically not a cut option for construction related activities. Now, with that said, there are some companies, Travelers is one I know of, that has a endorsement that will allow you to perform non-structural related items on an active policy.
So, for example, if I'm doing electrical upgrades, upgrading my electric panel for EV, electric vehicle, that will be covered.
The truth is if a lot of it comes down to how you are going to be occupying the home. So structurally is a pretty hard line no. So if they're doing structural related items, regular home insurance isn't going to cover anything related to that goes wrong. If you're doing an electrical upgrade, which people do to their houses all the time while they live there, part of getting solar, for example. If you're just doing an electrical upgrade and you're living in the home like normal and you're going to kind of maybe go without electricity, or you're going to just kind of be inconvenienced for a little while, there's nothing in the insurance that would say, oh, this is absolutely not covered, but it also depends on what goes wrong. So a lot of that also extends to the contractor. If the home was to burn down because of a short or something during that phase of the electrical getting swapped out, it would technically be on the contractor that did the work. Their liability would kick in at that point for damages that occurred. That's part of what they're doing, and the home insurance would be there, but the home insurance would be looking the direction of the contractor as well, because it's during the work being performed.
Okay, and for that contractor's coverage to kick in, we would have to be added onto their policy as additionally insured.
Not necessarily. So the contractor's insurance is going to be for anyone that files a claim against them or files a lawsuit against them. So if something goes wrong, you don't have to be named additionally insured. It is my recommendation to always either get a certificate with the client named on it, with a blanket additional insured endorsement, in a residential project where someone might only be working for a week or two, a full additional insured endorsement isn't totally necessary.
Okay, you said something that I have never heard before. Did you call that a blanket?
Correct. So additional insured on commercial policies has two options. You have a named additional insured where the policy gets addressed and named with the client as the additional insured. Or there's something called a blanket additional insured, which comes on most policies have that for contractors. And that says anyone that is under written contract is additional insured. So that's a pretty stock item with those types of contracts. As long as they have a blanket, it prevents needing first the extra cost of adding additional insured, but it also prevents the hassle of requesting full documented additional insured, because as long as you have a contract with the contractor, that blanket additional insured kicks in.
Got it. Okay. So I think what you said, if I understand you correctly, is this works if you're still occupying the property, but if you move out.
Correct. If you're going to be doing a full renovation of a home and you're not going to live there and you're going to move out, there's provisions within a homeowner's insurance that, depending on the carrier and depending on the provisions, typically 30 to 45 days. I've seen as high as 60. That as soon as you vacate a home for that period of time, then the policy limits itself. Some companies will limit all of vandalism will go away. Some companies will get rid of liability after that period. Some companies will get rid of, make the home insurance completely invalid for after a certain amount of vacancy period. So obviously leaving town for 2 weeks and going on vacation isn't a situation. But if you were to move out of the house and go live in a rental property for 3 months, there are other insurances that are needed in order to do that type of project and either replace your homeowner's insurance later or carry the two policies for that period.
Okay, so what are the policies that homeowners should consider in that case if they're moving out to do construction, do renovation?
Yeah, so they're all essentially do the same thing, but there is course of construction insurance, builder's risk insurance, and vacancy under construction insurance. All three of those are fairly synonymous with each other. Builder's risk is a course of construction policy, and then some vacant policies will have vacant with the ability to have construction built into it, because they're going to ask, why is the property vacant? Is it under construction? What's being done? It really depends on the seriousness of the renovations. The easiest way to break down the two is probably structural and non-structural related items. So if you're just doing a cosmetic rehab, paint, some floors, things like that, maybe vanities, toilets, that is non-structural and it's a lot simpler. When you start doing an add-on where you're adding square footage, adjusting the layout of the interior of the home, structural related items, load-bearing walls, those policies are a little bit more serious, because they're covering essentially that not only is everything going to work out, but it's also going to not present a problem of the work that's being performed from a structural standpoint after the fact.
Okay, so we did a project in Berkeley. We were not the homeowner. We were lifting the house from the foundation to add a ground floor, okay, a first floor. So an expansion that included a lift. And I think we had trouble getting insurance because we were touching the foundation.
So it would just be harder. So when we're doing anything that's related to structural, we have to put full details of what's being done. So if we were looking at a property that was having a first floor put in and the second floor put on top, then there was going to be a lot of questions on the process. What preventative measures are going to be taken to assure that the structural integrity of the property is going to be maintained and that there's not going to be any risks. They may even require some of the structural engineering plans to be reviewed. So that would be one that would be more difficult, but it's the same as ground up construction. That is also a course of construction policy. So it's obviously on ground up, you're doing the foundation. So that's the foundation itself isn't an issue.
Okay, so then these options you're talking about, course of construction, ground up construction as part of a course of construction, are these same policies and same coverages available for both homeowners and rental property owners?
Yeah, so it's really no correlation, no difference between the two. They're the same. What the end use of the project is really doesn't matter to the insurance, because the assumption is during that project and during everything, it's going to be vacant anyway. So it's really not a concern whether it's going to be a rental, whether it's a flip and it's going to be sold, or if it's going to turn into someone's primary home. Doesn't play a role of price or anything like that. Doesn't and availability for that matter.
Oh, interesting. So for our flipper clients that flip 3 to 5 single family homes a year, what do you recommend?
Well, and the best option is to get a policy for each particular project if you want to have that kind of protection. Also, if you're doing it for someone in particular, they need to understand that there's no insurance unless a course of construction policy is purchased. Oftentimes, people will say, "Oh, the contractor's insurance, the contractor covers this project while it's under construction." And that's only true to liability. The contractors don't typically carry a blanket course of construction for property. It's usually either built into the contract stating that you need to have the builder's risk policy, or it's stated pretty clearly that they, are not covering anything to do with the property during construction.
Okay, so a few years ago, I was involved at the tail end of a project. It was a tear down renovation, and and we were not the lender at that time, but within 1 week after the contractor started renovation, the house burned down. They had property insurance, the owners had property insurance, and the GCs had liability insurance. In a case like that, where the house burned down shortly after demolition, how does the insurance claim process work?
Yeah, so it wouldn't be the contractor's liability that kicks in because the assumption isn't that the contractor did something wrong. The contractor would have to be found negligent in some way for that to kick in.
Okay.
The assumption that the property was burnt down for other reasons means the property insurance would kick in. And when you do a course of construction, you're doing two things. You're doing either existing structure plus renovations, or if you're doing ground up, you're doing the whole project. So for simple numbers, I will take $1 million property and say that the property is insured for $1 million and the person is putting $250,000 into it. So the total coverage of existing and renovations is 1.25 million. So in that situation, they would have, depending on how far along or where they are in the process, they would have that money to not only to cover the removal of debris and the start over of the project, but also to pay for what's already been done to the property. So that's why it's important to first get the policy ahead of time, because you cannot get the policy halfway through the project. Insurance companies don't do that. You have to get the policy before work starts.
I did not know that either.
Yeah,
Okay.
because otherwise, technically from a fraud standpoint, someone could, get halfway through a project and think, boy, there's a lot of things that are not looking right. Things aren't going right. We should probably get insurance on this. And at that point, the ship sailed, because insurance companies also know if you haven't gotten insurance up front and you're looking to get it after the fact, well, why? What's changed? And in some cases, it's harmless. People don't know, or they're going to go get a loan and they didn't start with a loan, so there was no requirement for insurance. But that is a tough one, because once you get into the project, it's already begun, and that's a big no-no.
Okay, so let's dive a little deeper into that. So let's say we Abundance are the private lender on this property that was burned down. And we had the borrower add us as loss payee on the insurance. How does that work? How does that process work?
Well, the loss payee does mean that the money's going to route through Abundance or the lender that you placed them with. And so it's going to be like a normal homeowners insurance claim where there's estimates and an adjuster assigned. And that money is going to have to route through the loss payee and to the client. We see that with a loss payee on any regular homeowners insurance. If Wells Fargo is the loss payee on your homeowners insurance and the home burns down, Wells Fargo manages that money as it comes in from the insurance company back to the contractor and the homeowner. So it would be something, as the loss payee is named, they're going to kind of be in control of the distribution of the money that's paid out by the insurance company.
Okay, so I'll give a concrete example in this case. So let's say we're the loss lender payee and there has been a claim filed. So the insurance company would pay the amount to us, the lender, and we, the lender, would require the borrower to complete certain milestones before we release a certain percentage of the funding to the borrower.
In theory, I mean, again,
Yeah.
that is at the discretion of the lender, and it also depends on the phase in which the project is. But the insurance company most often, depending, it's not going to just write a check for the amount. So that's not how insurance works. Insurance is payout based on the loss sustained. So unless it's a very clear total loss limits where it's burned to the ground, there's nothing salvageable. Typically it's not just cut in one check, so it's going to come in phases, a lot like you mentioned with the phases and the milestones that the loss payee would require of the rebuilding from the contractor and the buyer.
Okay. Are there any types of endorsements you would recommend or any type of uh, dollar per square foot coverage for constructions?
Well, that's a tough one because it depends on the area pretty dramatically. So, in the price per square foot, we like to be at a minimum of $400 to $500 a square foot these days. That's the ideal number for kind of a general building situation, semi-custom. But I've seen as high as 1,000 a foot, not uncommon at all in some of the nicer areas in the Bay Area. So,
Yeah.
tough to reach places like Tahoe. The numbers up there climb well above the $400 or $500 a square foot. But I'd say oftentimes when we're talking about flips and we're talking about builders, it does help because we already have estimates. So if someone is already has gotten contractor estimates to do whatever the project is, we already know roughly what that number is going to look like, and we can kind of clear the price per square foot or the project value with the contractor that's involved.
Okay. Any special endorsements we should ask for?
Yeah, RCV. So replacement cost value is very important. Now, it's not always available. So the existing structure will very often be ACV, actual cash value, and then the renovations are going to be RCV, replacement cost value. And it depends on the age of the house and the condition and the updates that are there. But if a place is being flipped, oftentimes it is something that needs work to begin with. So it's going to be one that the existing property might be in need of a little love and some updating. And so the insurance companies are aware of that, and they're not going to give replacement cost on something that has a lot of issues to begin with, knob into wiring, a 50-year-old roof that is peeling up. They're only gonna cover ACV, but we'll get RCV on the replacement cost.
So let's say someone is bought a small house, 2 bedroom, 1 bath, 1,000 square feet, and they're going to be expanding that by let's say 2,000 square feet for a total of 3,000 square feet. At what point should they get the course of construction insurance? At the beginning, before they started doing the demolition?
Before doing anything,
Before doing anything?
yeah, before the home is touched, you ideally would like to get builder's risk insurance right away. Now, can you get builder's risk on something that some of the demo and such has started? Sure. It's just construction, so can't start. So they can't start pouring the other foundation for the expansion. Can't start framing in walls, any of that. And the ideal part is to use, instead of buying homeowners insurance, just buy builder's risk and liability so that you use that as your homeowner's insurance for the duration of the project.
Okay, got it. Does California Fair Plan offer fix and flip insurance?
They do. So it's not it's under their vacancy program. So when you do a vacant program, which by the way is typically only 1 year, the vacant program has an option, and it does say, is this under construction? And as long as we answer yes to that, it is, for lack of a better word, a builder's risk for Fair Plan.
And do they offer that for LLC owners?
Yes, you can do LLC, trusts, anything you need on California Fair Plan. It's not a problem.
Okay. We've had clients that had issues, or not necessarily issues, but it became a commercial policy.
It would in certain sections, not with the California Fair Plan. So the Fair Plan has on the dwelling products, which is their homes, 4 units or less. They have the option right out of the gate for LLC, trusts, any of that. Not a lot of issue with the Fair Plan for that.
Okay. And then this question actually came up very recently. A borrower is has bought a property and is going to tear it down. So they don't actually want any coverage on the dwelling itself. So all they're getting is general liability insurance. Does that sound right?
Yeah, it's actually called premises liability.
Okay.
So general liability will cover you anywhere you are, wherever you go. Premises is for a set location. So you can get construction premises liability for incredibly inexpensive. And it's for a site that's under construction.
So a lender, such as Abundance, should we be added onto the premises liability policy as well?
No, because technically speaking, the only thing that a lender cares about is being the lost payee for the money borrowed. The liability doesn't ever extend to the lender. It's not, the lender isn't going to be sued in a slip and fall situation. So it's the owner or then the premises that needs to be covered on the liability.
Got it. What about construction managers?
Yeah, so that's definitely, there's multiple ways to go that. When you say construction manager, I think you're thinking of more like someone who's managing the project, a project manager that is in the employment of the flipper or the person doing it.
Employment of let's say the homeowner.
Yeah, of the homeowner. Yeah.
Right.
So
And
yeah,
they
you can
manage the
absolutely
contractor.
name
Yeah.
someone.
Right.
Now, you're not going to name the contractor additional insured because you're asking the contractor to be there being naming you or giving you a blanket additional insured. But if I mean, it's not common, but if you have someone who's going to manage the project for you and they want to be a named additional insured for liability, they can, but just remember it's liability for the premises. So it's not liability for, you know, a beam falling from the ceiling. That's the contractor's insurance that covers that.
So I want to make sure that I'm understanding this correctly. Let's say I own a rental property, I own a primary residence, and I want to hire a construction manager to manage the general contractor and the subs.
Mhm.
Do I require insurance from them?
They're not going to carry it in most cases, so I would doubt it. But they, as well as you, both probably have to have the contractor either give a blanket additional insured by contract or a named additional insured. So that if the construction manager or the homeowner is sued, something that happens to a subcontractor, for example, which is common, that there's coverage under the general contractor's insurance for that. The premises liability is about the premises, something happening on the premises that's the homeowner's responsibility. Oftentimes that's slip and fall. Someone's walking down the driveway, trips over a 2x4. You're going to be named in that, although so is the contractor who left the 2x4 there.
Okay, so as a property owner, do I need to add the construction manager onto my builder's risk or course of construction insurance policy before?
No, because that policy is covering the structure. It's not covering liability. So you can add them on the liability if they require you to. But the reality is you don't really need to protect or shouldn't want to be protecting to someone who's managed this. You want to be protected from them doing something wrong. It really should be the other way around.
Got it. Yeah, so this separation of premise or dwelling coverage, dwelling replacement versus liability is a new concept for me. Because generally when we buy insurance, we buy one policy that has both. And we don't think about them separately. But it sounds
There
like
are builder's risks that come with liability. So it's not always that you have to do two separate policies, but some of the better products are just builder's risk and you have to get premises liability separately. Very inexpensive though.
Okay. Okay. So starting out in this segment 3, specifically about course of construction, fix and flip policies or insurance for fix and flip projects, do you have any other recommendations? For example, how much time to allocate to get insurance? Yeah.
Certainly. So, I mean, the biggest, and I touched on it already, is to do it prior to construction. That I think that's the biggest hang up that people run into. The biggest problem that people run into is you can't get halfway through and then realize you want to get it. And especially with a loan involved, if you don't have the loan up front, oftentimes people don't think about it. And then let's say they get halfway through and decide they want to do a cash out equity line or something to expand the project. If you're halfway through and there's no condition and there's no course of construction insurance in place, it does make it harder to get that insurance, and not a little bit harder, but dramatically harder and more expensive.
Yeah, and actually that's also true for loans. If you have started construction on your project and now you realize that you need more money, if you try to get a loan, lenders and title companies will not touch it.
Yeah,
because they don't want the risk of mechanics liens.
There's all kinds of, yeah, there's all kinds of things that can go wrong by getting in halfway through. So besides that, besides the only other thing to kind of keep in mind is obviously that you need to get the right policy because the homeowner's insurance doesn't cover it. And oftentimes that's just the assumption is it will. The other assumption is that your contractor's got it covered. Both of those things are just not true. The contractor's almost never going to cover, there isn't a policy a contractor would carry very often at least, that is going to blanket cover any project they work on for the property damage. And that's because there's just no way to know what that project is. I mean, you could have a $50,000 kitchen remodel, or you could have a $5 million rebuild. So it's really impossible for an insurance company to give a one size fits all policy to a contractor for whatever it is they work on. And so the only real protection usually comes from something that the homeowner purchases themselves.
So actually, on that note about contractors, so if I were to hire someone for $1 million construction project, major construction project, should I expect them to have at least $1 million coverage assigned, liability coverage assigned specifically to my project?
So it's occurrence based. So $1 million is the minimum in commercial anyway. So it'd be $1 million is going to be what they have. Sometimes you could get two, sometimes you have an umbrella. But it is $1 million is occurrence based. So it's when it happens, there's up to $1 million for that occurrence. So it's not necessarily that it's tied to your project, but it's tied to when something happens at your project.
Got it. Okay, that does it for this segment. And this is also very complicated, especially since most of us don't do construction on a regular basis. So for all you homeowners, if you're thinking of a construction, reach out to your insurance brokers, reach out to Sterling well in advance. Sterling, do you think 3 weeks, 4 weeks is enough?
Yeah, it depends. I mean, typically that's more than enough. In most cases, we can usually get it done in a couple days. It depends on the complexity of the project. Obviously, a ground up multi-million dollar home is going to be a lot more complicated than someone who's just doing a fix and flip, putting $100,000 in to renovate a house. So one of the other things that makes a big difference on timing is the age of the home. We're seeing in the Oakland and greater San Francisco area where you're 120-year-old homes that are getting renovated. Makes sense because they're 120 years old. Those are a little bit harder to place than something that's 50, 60 years old. There are caps or minimums. Some companies 1900 and newer, and some companies are 100 years or newer. And at this point, 100 years is 1924. There's lots of homes that are pre-1924 out there that need a little bit of love. And so those, I imagine, are going to be targets for people who are doing flips.
Yeah, we have, so we're recording this in November 2024. One of our clients has been shopping aggressively for a course of construction insurance on a property in Burlingame. And the insurance quotes came in between 12,000 and 40,000.
Wow.
Yeah, and it's taken them 4 weeks so far. And I don't think they've gotten very far yet.
Yeah, no, it's the more complicated the project, the more time. My suggestion is to always call someone early, find out, set expectations, ask them those questions. How far in advance do we need to do this? Because the other part is that I know that the loans can sometimes take a little longer if there's a lot of due diligence on that side, and then sometimes you may not be wanting to start the project for a few months, but if there's a lender involved, they're going to need that proof of insurance right up front. And Yelsey, you can chime in on this. The other thing we see is your project may not be an annual project. It might only be a 3 to 6 month project. So lenders typically do want a year of insurance coverage in a lot of cases. And so you would want to target an insurance company that is prorated. And so that if you bought an annual policy because of lender's requirements, that you are comfortable that you're going to be getting back the remaining 6 months if you finish after 6 months as a refund, because not all carriers are prorated. Some carriers are project based. So what you pay up front is what the insurance company is collecting.
Yeah, that goes back to the minimum earned premium we talked about last time.
Correct. 25% minimum earned is typically the standard, which is 3 months. And most carriers are going to have a hard time getting on a project for less than 3 months, just because the juice isn't worth the squeeze. They can't charge enough premium in a short period of time. But it's very important after that you have a prorated policy if you're doing a policy that needs 12 months based on lender requirements.
Yeah. So as a private lender, we often get real estate agents calling us, hey, can you close escrow in 7 days? And my
Yeah,
biggest question right now is, hey, are you going to be able to get insurance in 7 days? And usually at the beginning, they would say, oh, sure, no problem. I'll just call up, I say AAA, and they'll get it done next day or in a couple of days. And then they would come back and say, sorry, that doesn't work. And when I
yeah,
remind them, hey, it's going to be vacant. You need to get vacant property insurance. It's a total shock for them how
yeah.
different the world is.
And you can get it in 7 days. I mean, it is realistic. Depends again on how difficult the project is, the
Yeah.
location, the construction quality, the current condition of the house, the year built. But if if we're going into it knowing what we have, what our turnaround is, the one thing you might not get is the best option in 7 days. So
Right.
there's carriers that turn things around very quickly. They tend to be the most expensive. If you have more time than that, obviously you can do a better market search.
So, Shirley, I have a question for you, and you may not be able to answer this. Are you seeing home buyers coming to you with an insurance contingency?
Very
Is it
much
that
so.
you are?
Yes.
That's
And we're
amazing.
actually starting to even see that some realtors are requiring a hard copy of a quote, a physical PDF quote to submit an offer. Because they've had so many deals that have fallen out of escrow because of the insurance being difficult to get or more expensive than they were expecting, where someone gets a week, 2 weeks into escrow and then falls off because they find out that the insurance is more than they thought it would be. So not only are we seeing contingencies on insurance, we're also seeing physical copies of quotes being required just to submit an offer.
Amazing.
Yeah, different
Amazing.
times. There's different
Different
times
times.
right
Yes, indeed. That's why we're doing this segment.
now. Exactly.
All right. So let's well wrap this one up, and then in the next segment we'll be talking about general liability and professional liability, and then Sterling, maybe you can also talk about premises liability again to
Sure.
differentiate the three options.
Absolutely.
So everyone, stay tuned. Please subscribe and like this video and share it with your friends and family who might be um, seeing notice of non-renewal on their policies, and also for your clients or for people who are considering doing constructions. All right. Thank you, Sterling.
Thank you, Elsie.